Good morning. It's Jeffrey Christian of CPM Group. It's just before 11 o'clock on Friday morning, the 26th of January here in New York. I'm going to talk about the economy and our view of where the economy is and is going, and how that may affect or how it affects our views of where gold, silver, and palladium prices may head over the near term. Now, I'm going to speak primarily about the U.S. economy. The rest of the world is important, but given the prominence of the U.S. dollar, both in terms of monetary reserves held by governments and financial assets held by private entities, and in the use for international trade and capital investment flows, the U.S. economy is extremely important. The key issues related to the Chinese, the other countries are issues within the Chinese economy right now, and then also the fact that you've seen better performance in the EU and the UK than what had been expected by the financial markets and by governments and by CPM Group itself. I have a lot of points I want to make, so I'm going to be looking over here at the notes that I've written for myself here, there. So again, the U.S. dollar, very important on an international basis. It has not been collapsing. It has not been falling. It is off a little bit from its peak. But if you look at this chart, which goes back to, I think, 2006, you'll see that over that time, as various gold promoters have continually talked about the imminent collapse of the dollar, it has not imminently collapsed, and it's probably not going to collapse either. So I think that's very important to remember. You have to remember, no one's abandoning the U.S. dollar. Dollar's not collapsing. There's no sign that the dollar is about to collapse. For the dollar to collapse, because it's a reciprocal with other currencies, there has to be much more bullishness toward European and UK and Japanese and Chinese and other countries' economic performance relative to the U.S. And right now, and on a longer-term basis, the U.S. has a lot of strategic advantages and competitive advantages over those other parts of the world. So it's highly unlikely that you'll see the dollar collapse anytime soon. And in fact, many countries see a strong advantage to having a strong dollar, partly because 60% of their foreign exchange reserves are held in U.S. dollars. So no one's abandoning the dollar. Similarly, no one's abandoning U.S. Treasury bonds. The bid to offered ratio in Treasury offerings has been running plus 2%, in line with previous ratios. The Treasury could sell twice as many bonds as they wanted to, as they have been. And the Fed could expand money supply eightfold based on its balance sheet if they needed to. Neither of them anticipate doing anything like that. Neither of them anticipate the need to do anything like that. They do not think they need to. But you do hear drumbeats from gold promoters and other snake oil salesmen over time about how, hey, there's going to be a squeeze on the dollar and there's not going to be sufficient dollars, et cetera, et cetera, et cetera. It's just not there. Now, in talking about the economy, I want to try to avoid the issues of what CPM Group has been projecting compared to or versus what the financial market consensuses have been, and how we've been mostly right and the consensus has been consistently wrong. For 2023, we said we thought we'd see a continued economic expansion, albeit at a slower pace. We were wrong. We did see a continued economic expansion, and it's been much stronger than it had been in 2022. But we did not see a recession in 2023. Now, you see the market consensus talking about a soft landing. I'm not sure what a soft landing is. I think a soft landing is a prolongation of a period of relatively slow economic growth, usually followed by a recession. So I'm not quite sure. I mean, I guess we have seen some soft landings in the future. I'll show you a GDP chart in a second about that. And similarly, we had expected inflation to come down modestly in 2023, and it did. There were some issues there too. Now, the Fed is charged with balancing, trying to keep inflation in check and maximizing economic activity as measured by employment. So those are the two things that the Fed looks at. And those are the two things that you should look at. Right? Now, inflation as measured by the personal consumption expenditure data, which came out today for December, continues to decline. The headline, which I believe is on the the right-hand side of this chart, the right-hand chart, was about 2.6%, and the core, which excludes food and energy, was 2.9%. So they continue to head in the right direction. Those gold bugs who keep telling you that, we're on the verge of hyperinflation, et cetera, et cetera, et cetera, the data does not suggest that. We talked about in past videos the fact that you are seeing a stronger decline in headline inflation than in core inflation because one of the big factors there has been a sharp decline in energy prices, primarily petroleum products, heating oil and gasoline, and to a lesser extent, natural gas. That puts the inflation trends a little bit at risk. There have been people who have been saying that the political and military problems in the Middle East probably will lead to a sharp increase in oil prices. It hasn't happened. Oil-producing nations within the Middle East don't want that to happen, and they probably will not take any such steps as to cause that to interrupt. So we're looking at oil prices basically close to the low end of the range that we expect for the next year. The range that we expect is, say, $70 to $90, $93, and we're down at the low end of that. So we do have the potential for some increase, but we don't see the oil price exploding over $100 for the next several years at least. So we're now looking for a sharp spike in oil prices. We're not looking for political and military problems in the Middle East to push prices up. We wouldn't be surprised to see some strength in oil prices, especially because we're seeing relatively strong economic activity. The Fed looks at inflation. The PCE price index is its preferred measure, and this is what it's showing them, that there is inflation coming down. It's still above their targets, and they still feel that they have some work to go in quelling inflation. The other thing that the Fed looks at is employment. And U.S. unemployment is at the lowest rates, at its lowest rate since the 1960s. So employment's doing very well. And it's not pushing inflation up, so it seems. Employment keeps rising as well. These are the actual level of jobs in the United States. So when people try to paint a darker picture than reality, they say, well, unemployment's down because people have left the workforce. The workforce is growing, and we've actually seen workforce participation rates rise over the last year as people who had given up looking for jobs in the pandemic and the aftermath have gone back and are looking for jobs and finding jobs. So employment keeps rising. Unemployment is at the lowest level since the 60s. The Fed sees the U.S. economy in a kind of a sweet spot. Makes the policy a little bit more difficult. And this is U.S. GDP. The data came out yesterday for the fourth quarter, and it was 3.3%. You can barely see it over there, but 3.3%, 4.2%, I think, in the third quarter. We're seeing stronger real economic activity in the United States. And in fact, over the last half of 2023, I believe that the GDP was better than the average over the previous 10 years, excluding that big sharp decline during the pandemic, second quarter of 2020, and the big sharp increase in the third quarter of 2020 following the sharp decline. So you take that out and you have relatively good economic activity. Now, let me just make sure that I'm capturing everything here. I want to run through some other economic indicators. And I just picked some. I mean, I could go on forever. When I was at Goldman Sachs, I reported to the chief economist, and he had a monthly report called the Pocket Chart. And he had started off with something that you could actually put in your coat pocket of key charts to look at. And as he found more and more things of value and importance, it got to be like a 60-page saddle-stitched report, still called the Pocket Chart Room. I can dump a lot of charts and data points here as somebody who was foolish enough to debate me about gold conspiracy theories said after the second debate when I tore him apart. Don't debate with Jeff Christian. He comes loaded down with facts and statistics that makes the debate difficult. I could go through a lot of things. I just want to pick some points out here. This is housing construction, and it's housing construction in the United States. Excuse me while I look at it. The right-hand chart is the more interesting chart. Well, they're both interesting. The left-hand chart is total housing construction. And you can see it's the highest level since the early 1970s. There's a tremendous amount of housing under construction. The right-hand chart is multi-unit, 5 units or greater housing construction. And it's even higher. It's even greater. One of the big problems the United States economy is facing and has been facing is that we don't have suitable housing for people. Housing like auto industry, the housing industry makes a much bigger margin with McMansions than it does with houses that are suitable either as starting homes or as empty nesters downsizing their houses. So there's been a terrible mismatch between the construction industry building too large of houses that no one really wants or could afford because they get a better margin, and building and not building the kinds of smaller houses that young people and old people want. But we're seeing a tremendous growth in multi-unit construction. It's under construction now. So it should be expected to be completed over the next 12 months. We'll see how that rate holds up. But the expectation should be that housing costs will move lower because of a tremendous growth in housing units under construction now that will be coming into the market. That will help with inflation somewhat, and it will help with overall economic activity. Now, this is consumer spending. Consumption expenditures also continue to rise at a steady rate equivalent to the rate that we saw after the Great Recession, from say 2010 into 20 and through 2019. Came off during the pandemic, came back, and we're back to that sort of steady growth in consumer expenditures. That's very important. You look at personal savings rates. Yeah, they skyrocketed during the pandemic with the government payouts. They've come back down, and they're at the levels that we saw in that period, 2010 to 2019. Healthy, stronger than they were prior to the Great Recession. You can see how much lower personal savings rates were, personal savings were prior to that. And you can see that there is ample capacity for future consumer spending in terms of personal savings. And then the last one that you see is disposable income, which also suggests greater capacity or strong capacity for consumers to continue spending. So you have a lot of strengths in the economy. That doesn't mean that you don't have a lot of weaknesses. And I want to run through a few points here. One is, it's not just the lies and misrepresentations in the precious metals markets I hate. I also hate the lies and misrepresentations in the broader economy and financial markets and political realms, right? Second thing, and this is very important, recent trends should not be necessarily be expected to continue in the near-term future. And I'm going to go back to here. Why does the Fed lower interest rates? Because the economy is getting weaker. Why does the Fed raise interest rates? Because the economy is getting stronger. How do we go into recessions? We go into recessions in all sorts of different ways, but usually they're from a strong point, and then consumer spending and corporate spending and government fiscal policies muck things up, and you go into a recession. So the strength that we've seen in the last 2 quarters actually kind of makes the economy more vulnerable to a recession than it would have if you looked at, say, the previous 2 quarters when the growth rate was in the 1% to 2% rate. So we're seeing that stronger demand, stronger economic activity, and those projections, the strength actually is more worrisome in terms of the potential for a recession later this year or into 2025 than would be lower, weaker growth. So it's something to pay attention to there. Another thing is that we work off of projections. Projections of existing realities are often much more accurate than forecasts that don't necessarily reflect what's actually happening in the real economy and financial markets. And then again, you also have a point that I've made repeatedly in past videos. Fiscal policies can muck all of this up in a heartbeat. And that's particularly worrisome right now with the fiscal dysfunctionality in both the U.S. administration and the White House and Capitol Hill. We have a tremendous capacity to see all of these good things happening in the U.S. economy disappear. And even if they do continue, you're going to hear Republican candidates talking about how terrible the economy is. It's just not. Okay? Third point I want to make. Notice I did not include here a chart of the stock market, which is now at record levels. That's because the Fed does not tailor monetary policy to support the stock market, despite what the carnival barkers say. Right? The Fed pays attention to unemployment and inflation, the two things it's chartered to pay attention to, and the real economic trends that indicate where those two factors are heading. That's the real economy, and that's what you have to look at, because that's what the Fed is looking at, and that's what CPM Group's looking at. So what's it all mean for gold and silver, platinum, and palladium? Stronger economic conditions over the next couple or few quarters suggest a tempering of the investor demand for gold, and consequently prices consolidating. We don't see prices falling sharply. We don't see prices falling below, say, $1,850 at the lowest, and we're not even sure that you'll see that. We think that prices may stay much higher than that. It's about $2,022 right now as I speak. But we don't necessarily see the price rising sharply until you get further down the road economically or we slip into a recession. We do think higher prices are coming, but not in the next couple of quarters. It's going to take further developments in the economy and the political environment for that to happen. Silver, very similar. We kind of look for it to continue to move sideways. It is additionally suffering from investor dissatisfaction, which is limiting its upside potential at this point relative to gold. We do think that silver will play catch-up in terms of percentage appreciation, but right now silver is suffering from that additional factor that a lot of investors have been disenchanted by what's going on. Now, platinum and palladium prices, stronger economic conditions should boost auto demand and auto industry demand for platinum, palladium, and rhodium for use in auto catalysts to clean up exhaust. And it should also boost investor interest in platinum and palladium based on the expectations of stronger automotive demand for these metals. However, it's not necessarily happening right now due to shifts in consumer attitudes toward automobiles and toward auto ownership and the rise of EVs. The rise of EVs is taking market share away from platinum and palladium because they're not used in EVs because there's no petroleum being burned and harmful gases emitted. In addition to that, you're seeing demographic shifts in the perceptions of auto ownership, which is probably reducing the rebound and demand levels that you're seeing for platinum and palladium and for autos in overall, and thus platinum and palladium for use in manufacturing those autos. As a result, we see platinum and palladium prices continuing to remain under pressure. We are more optimistic that platinum prices can rise. We do think there'll be periods when palladium prices spike higher, but palladium, as you can see, has been in a downward trend for the last 2 years. And our expectation is that that period of stronger palladium prices is behind us now. And as I said, we came out with our report, Platinum, Palladium, Rhodium to the year 2050 at the end of December. And in that, we make the point that over the last 50 years, platinum, palladium, and rhodium prices have been very strong because of the rise of automotive use of these three metals. And the next 50 years may see the downside of that same cycle as the auto industry pivots away from petroleum fuels slowly and uses significantly less PGMs. We still see petroleum fuels powering 40 or 50% of the vehicles that will be manufactured and bought in 2050, quarter of a century from now. But that's half of what they are now or what they were 5 years ago. So we see that downward pressure. That's all I have. Next week, we'll have our open forum for our clients where clients can ask us questions and we'll try to answer them. We'll have our Silver Fact and Fantasies coming up toward the end of February in advance of the PDAC, and then we'll have our silver reception there. Later in March, we'll come out with our gold yearbook. In May, middle of May, we'll have silver, and middle of July, we'll have platinum group metals. So you can go to our website, you can buy our reports, you can read some free reads and watch free videos. You can learn more about what we can do for you as an investor or a consumer or a producer of precious metals and other commodities. You can send us an email at info@cpmgroup.com and say, hey, I'd like to be your client. Let's talk. And we will. That's all I have for now. Take care. Have a good weekend. I'll see you next week, and we'll talk about some other aspects in the precious metals markets. Take care of yourself. Take care of those around you. And do something good for the world.